Hi, everybody. Chris Englebert with Englebert Financial Advisors in Allentown, Pennsylvania, and time flies. Seems like we just did the August update. Now we're rolling into September. You can see by my background, the leaves might be changing where you're at. Hopefully we have a really good fall, stays nice and warm. But we have to talk about September and what's going on. And obviously we are getting closer to election time. I'm getting more and more questions about what I think is going to happen with the election. And to be honest with you, it's a very, very difficult thing to forecast. But we are concerned that in the 2 months leading up to the election, September and October, that there may be more political volatility, not so much here in the US, but more overseas. So we're monitoring that closely. We'll see what happens. But let's talk about what's going on in the stock market. And we've had a pretty good ride. I mean, we saw the S&P 500 peak in the middle of July, followed by a sharp decline of 10%, only to rally back almost 10%. The S&P 500, as of this video, has not made a new high yet, but we're going to show you that the Dow Jones Industrial Average has. The QQQs, or the NASDAQ, got hit a little bit harder. They're down about 15%. They have not quite recovered from that standpoint, but you can see we kind of had a scary sell-off, but it looked like there was an all-clear sign. Now, our risk indicators are still elevated. We thought that the 10% decline that started in July would go a little bit deeper, maybe 15, even 20%. We were wrong. We came down 10. We turned right around and came back up. But our risk indicators, once again, are pegged and showing that there is a higher degree of risk in the U.S. equity markets at this point in time. So like I said, the Dow Jones Industrial Average printed a new all-time high. Now, just to give you an idea, when people talk about the different averages and different investment styles, the NASDAQ or the QQQs is typically a large cap growth technology index. And everybody says, hey, if I want to buy tech, I'm going to buy the NASDAQ. The S&P 500 is more of a hybrid, a lot of tech exposure, but it also has obviously financials, energy in it as well. It's the S&P 500. The Dow Jones Industrial Average is kind of considered an older index, so to speak. Doesn't have quite as much tech to it. It has more consumer staples, more of the drug companies in it. And so therefore, what we believe is happening is that you're seeing the rotation out of the highly valued tech indexes into the more indexes that are more value-oriented, more dividend-oriented, and that would be the Dow Jones Industrial Average. So we're always looking for signs as to where money is rotating into. And if you remember last month, we think that there's a lot of money rotating into the small mid-cap stocks as well. And we think that's what's happening is investors are realizing many technology stocks are priced to perfection, and that if they're going to make money in the stock market going forward, they've got to look at either large cap value, small mid-cap stocks, etc. So what's going on with interest rates? In August, we had the big Jackson Hole, Wyoming Fed meeting, and Jerome Powell came out of that meeting and he made a lot of dovish comments saying that they thought that they had inflation under control. So we have seen the 10-year Treasury yield float down to about a 376, 375 level. Now remember, last year in December 31st, we had the 10-year Treasury at a 386. That's where it ended 2023. We then ramped up to 4.7% back in May. We have now come all the way back down to 3.75, 3.8%. Now, does that mean that the Fed's going to lower rates dramatically on the short end? Again, we still don't think so, but they're looking at the fact that they have supposedly inflation under control and the bond market's following it. Now, sometimes when the bond market has yields come down, it's signaling a recession. So we're keeping an eye on this and we're trying to figure out, are we going into a recession in Q1 of 2025? And is that what the bond market's telling us? So right now, we actually think the bond market on the longer end is fully valid, because if we get some good economic numbers, employment numbers in September and October, you may see the Fed reverse and say, hey guys, we don't have to lower interest rates. And we think the 10-year could back up over 4%. So right now, we're not buying longer term bonds. If anything, we're staying on the short end of the bond scale. So to wrap it up here for September, the stock averages had a quick, sharp 2-week decline in July, beginning of August. We then saw a pretty healthy rally, what I consider a bounce But then we had the Jackson Hole Summit. Again, if you ever want to know why they have their meeting in August in Jackson Hole, just Google it. They had one Fed governor who used to not want to come to any meetings at all. And the only way they could get him to a meeting was to have in Jackson Hole and promise them trout fishing. But so after that summit, Chairman Powell made a lot of dovish comments. So when you hear people say, we're making a dovish comment or a hawkish comment, the Fed was hawkish in their verbiage today, that really means where they think interest rates are going to go. Dovish comment means they think interest rates can glide lower. Hawkish means that interest rates are going to go back up. But again, we think that the 10-year has kind of gotten ahead of itself. I would not be surprised to see if we have some decent economic numbers in the next 2 months, especially employment. You'd see the 10-year Treasury back up over 4%. Again, we're pointing out that the NASDAQ is lagging. Equity money managers and investors believe that the technology trade is too crowded. We agree with them. They're looking at, instead of the Magnificent Seven, they're looking at the other 493 stocks that are in the S&P 500 now. And we think that so far, going into 2025, dividend paying stocks and value stocks, some of which are the same, look to be a good place to be in going into 2025, and also small mid-cap stocks. So that's our first of month update. We'll be back next month. We'll talk to you soon. Everybody take care.